When Ronald Reagan was inaugurated into office in 1981, he was coming in at a time of an economic recession, which was brought about by a tight monetary policy in an effort to combat increasing inflation. Previously, policymakers believed they could lower unemployment through higher inflation, which is referred to as the Phillips curve. When he became president, he appointed Donald Reagan as the Secretary of the Treasury. Reagan, who had been the CEO of Merrill Lynch, would engineer solutions to deregulate large companies through corporate tax cuts, as well as reducing taxes on income and altering tax codes. President Reagan's administration adopted the term Reaganomics, which heavily sided with the supply side of economics. This theory supported the notion that tax cuts would expand the economy, where the increased revenue would offset cash lost in tax cuts. Looking to deregulate large companies, he reduced the corporate tax from 46% to 34%. In doing so, he hoped to slow government spending and deregulate business industries. He also pushed for the Federal Reserve to decrease the money supply in order to resist inflation. In 1982, Congress cut the top tax rate from 70% to 50%, which helped increase GDP by 15.1% over the course of 3 years. The same year, Congress also passed the Garn-St. Germain Depository Institutions Act, which removed restrictions on loans-to-value ratios for savings and loans banks. The budget cut also reduced regulatory staff at the Federal Home Loan Bank Board, resulting in banks investing in dicey real estate ventures. The deregulations and budget cuts contributed to the savings and loans crisis in 1989. While during Reagan's presidency, his implementation of tax cuts and deregulation aided in an economic boom between November of 1982 to July of 1990, with GDP up 36%, 20 million new jobs, and the Dow Jones Industrial Average being up 15%, there were also some causes for concern. These concerns came in the form of spending deficit rising from $79 billion to $221 billion, as well as the federal debt increasing 2.1% to reach $2.9 trillion by the end of his second term.
So now I'm going to be talking about the consolidation of financial firms. So in 1890, the Sherman Antitrust Act was approved, which basically made it illegal for business groups to merge into one large company that would dominate that particular industry, also known as like a monopoly. And so then fast forward 100 years to the 1990s, when the financial sector consolidated into a few firms, which basically sounds like a violation of this Sherman Antitrust Acts, because these few firms are basically like forming a monopoly over the entire financial market, which is under them. And these firms were also so large that their downfall could take down the entire economy, which I think is kind of funny that they mentioned that, because that's ultimately what happened. And then moving on, in the 1990s, Bill Clinton was president at the time, and he was fully on board with these consolidations of the financial firms, because he was in favor of like deregulating the financial sector, which basically this was doing. And then one of the big mergers that happened during this time was in 1998, when Citicorp and Travelers merged, which was a direct violation of the Glass-Steagall Act, which prevented banks from investing in risky investment banking with consumer dollars. And so when they merged, they were kind of like making this happen. And Alan Greenspan saw this, and he knew that it was illegal, but he decided to exempt them from this law because he was also in favor of deregulating the financial sector. So then moving on to 1999, when the Gramm-Leach-Bliley Act was passed, which repealed the Glass-Steagall Act and allowed banks to continue merging in order to increase their profits. And this also allowed them to invest consumer dollars in like risky investment banking. And so this, moving on to the, like in 2000, the financial sector, because of everything that had occurred earlier, had become an enormous powerhouse. So there was only 5 investment banks, 3 security insurance companies, and 3 rating agencies who controlled the entirety of the financial sector. So they were basically able to be a huge powerhouse, and ultimately this led to their downfall and led to the Great Recession. But they were responsible for taking trillions of dollars from consumers and connecting it with investors across the world.
Hello, I'll be talking about the economic recession that occurred in the early 2000s, specifically the technology bubble. This took place in 2001, that resulted in $5 trillion in investment losses. Specifically, multinational companies had been drawing profits by engaging in illegal means and fraudulent activity. Their accounts made some serious loopholes and debts that were not shown on the market. Another reason for this economic recession is due to the overvaluation of stocks, and these stocks were shown at too high of prices of earnings, which led to them to eventually to fall. This was basically a result of a poor P/E ratio, which is basically a price to earnings ratio. So showing that you have an overvaluation of your market or your price is fraudulent, because you're not being honest with investors on how much your company is worth. And this eventually resulted in the downfall or recession. An increase in internet tradings is eventually what happened or occurred during this time. The internet being created allowed an access to trading for traders that lacked experience. This led to the losses in the stock trading market because of inexperienced traders being able to have certain loopholes and to overvalue their prices in the market. Another reason is investment bankers at research firms put not so honest ratings on the stocks, which led to an overall loss of wealth in the market overall. Basically, they promoted internet companies that they knew would fail, which is very corrupt. And basically, the Securities and Exchange Commission did nothing about this, even though they knew everything that happened. I think this has direct correlation with what happened in the financial crisis in 2008, and specifically what led up to it.
Now I'll be talking about the SEC deregulation that occurred. So during the bubble, investment banks were borrowing heavily to buy more loans and to create more CDOs. So there was a borrowing ratio that was happening called leverage. The more the banks borrowed, the higher the leverage. In 2004, Henry Paulson, the CEO of Goldman Sachs, actually helped lobby the Securities and Exchange Commission, the SEC, to relax these limits on leverage so that the banks could borrow more. In April 28 of 2004, the SEC met to consider lifting these leverage limits, and the meeting ended in the decision to go ahead and go through with this deregulation. Because of this, investment banks ended up significantly increasing their leverage, significantly increasing the amounts they were borrowing, and it shot up to incredible, ridiculous numbers, kind of a ratio of 33-1 almost. So incredibly high, borrowing so much, and really allowed to do these insane things because of the deregulation and because of the lobbying that happened. So a lot of different people were involved, different entities, institutions, groups that all kind of took steps that created this sort of domino effect. And one person allowed the other to do this. In this case, the deregulation here was a big moment that allowed these banks to borrow even more and more to create more CDOs.
Moody's, S&P, and Fitch make billions. These were the three rating agencies that made billions of dollars giving high ratings to risky securities. Moody's, the largest rating agency, quadrupled its profits between 2000 and 2007. The more securities they gave a AAA rating to, then the more money they made per quarter. AAA ratings grew from just a handful to thousands and thousands. Jerome Fons, the former managing director of Moody's rating agency, says that hundreds of billions of dollars were being rated per year. These rating agencies could have stopped this by tightening their standards, which would have cut off the flow of money to risky borrowers. The rating agencies argued that when they rated something as AAA, it was just merely their opinion and shouldn't be solely relied upon. The members of the Council on Foreign Relations tell us that the rating agencies were accused of misrepresenting the risks associated with mortgage-related securities.
Our next key event is the downfall of Bear Stearns, a large investment bank. During the housing market boom, Bear Stearns, like many other investment banks, became heavily involved in risky mortgage-backed securities. After the housing boom and the subsequent housing market crash, Bear Stearns was forced to pay around $3.2 billion to bail out their high-grade structured credit strategies fund, which specialized in risky investments like CDOs, collateralized debt obligations, and mortgage-backed securities, MBSs. In the fourth quarter of 2007, Bear Stearns recorded their first loss in the first time in the company in 80 years. CEO James Kane stepped down and was replaced by Alan Schwartz in January of 2008. On March 11th, 2008, the Fed announced that they would be lending $50 billion to struggling financial institutions. The same day, the ratings agency Moody's downgraded Bear Stearns mortgage-backed securities to mostly B and C levels, also known as junk bonds. Bear Stearns relied heavily on short-term funding deals known as repurchase agreements or repos. The downside to these is they highly rely on investors' confidence due to their short-term money exchanges. The Fed's announcement and the Moody's downgraded scared investors to pulling out of Bear Stearns. And then on March 13th, 2008, Bear Stearns only had $3 billion cash on hand, not enough to continue day-to-day operations. To repair the damages, Bear Stearns CEO asked JP Morgan Chase, who manages their cash, for an emergency loan to save the company. The Fed agreed to grant Bear Stearns a loan through JP Morgan Chase. Unfortunately, when the New York Stock Exchange opened on Friday, March 14th, the bank's stock plummeted and was soon valued by JP Morgan Chase at only $236 million. In fear that Bear's failure would be a catalyst for the decline of other risky mortgage-based investment banks, the Fed called an emergency meeting on a weekend, which was the first time the Fed had called an emergency meeting on a weekend in 30 years. And on Sunday, March 14th, 2008, Bear's board agreed to sell the company to $2 a share to JP Morgan Chase. The Fed eventually ended up lending JP Morgan Chase up to $30 billion to make the purchase. And after continuing negotiations, the share price agreed to be sold at would be raised to $10 a share.
On September 15, 2008, Lehman Brothers filed for bankruptcy with $639 billion in assets and $619 billion in debt. At that time, they were the fourth largest investment bank in the United States with 25,000 employees worldwide. The downfall of the company, like many other financial firms at the time, came from them venturing into mortgage-backed securities and collateral debt obligations. In 2003 and 2004, Lehman Brothers amassed 5 mortgage lenders along with BNC Mortgage and Aurora Loan Services. These companies specialize in Alt-A services, which can be quite risky given that the borrower does not fully have to document their income, assets, and expenses. Initially, this enabled Lehman's real estate enterprise to surge 56% between 2004 and 2006, bringing in $146 billion of mortgages in 2006. In 2007, the company recorded $4.2 billion in net income on $19.3 billion in revenue. By February of 2007, Lehman stock was at $86.16 a share, giving them a market capitalization of $60 billion. However, issues began to arise in the U.S. housing market and defaults on subprime mortgages began to rise. In August of 2007, Lehman stock fell drastically as the credit crisis arose, as well as 2 hedge funds run by Bear Stearns collapsing. The same month, the company disposed of 1,200 mortgage-related jobs and closed their BNC unit. The Lehman Brothers continued to underwrite mortgage-backed securities, which equated in an $85 billion portfolio. Although the equity market was rising at this point, the company failed to decrease their large mortgage portfolio, which would eventually lead to their bankruptcy. By the first week of September 2008, the stock had plunged 77%, with no hope of banks or investors taking a stake in the company. Lehman Brothers continued to deteriorate at an expedient rate. The attempts to restructure and save the company were unsuccessful, and on September 12, 2008, they closed trading. By September 15th, when they declared bankruptcy, their stock had plummeted 93%. 2 days after the company declared bankruptcy, the market for commercial paper issued by banks collapsed. It is argued that the government's refusal to save Lehman Brothers played a large role in the collapse. This presented a weakness in the banking system given that large financial corporations such as the Lehman Brothers and Merrill Lynch exposed the fragile state of the financial sector. However, if you look at other variables, the fall of the Lehman Brothers was not the sole perpetrator in the commercial paper market plummeting. Government bailouts did not eliminate fear when it came to the credit market. Therefore, who is to suggest that it would have provided liquidity in the commercial paper market? On the contrary, the Federal Reserve offering to buy commercial paper through a special purpose vehicle reestablished liquidity, given that it allowed borrowers with healthy collateral to borrow. In essence, it provided liquidity to sound businesses while weeding out the unhealthy ones.